Okay. So we're going to start this quarter just with a little bit of a synopsis on where we are and where we've been. So as of today, year to date, the market is up about 0.25%, which is actually slightly higher than what you probably had seen in recent reports as of the end of Q2. So the market is actually up on the year. Does not tell the story though of what has happened and what continues to be the main issue right now. So from February 19th, the peak of the market, to March 23rd, the trough of the market, the S&P 500 was down about 35%. And then from that trough, March 23rd, actually all the way through today, the market is still on a little bit of an upswing. We've come back about 45% on the S&P 500, which so the upswing was actually slightly larger than the downswing, but when you take into consideration percentages versus actual value changes, it means on the year we're fairly flat, a little bit positive. So what we're going to focus on, and really the main thrust of our research and our commentary this quarter, was how does that make sense when Q2 GDP fell by a third? 33%. That's what Q2 GDP was annualized down 33%. So that's a pretty big disconnect when you have a market that's going up and seemingly relentlessly going up. When GDP is down and the economy continues to be, for the most part, shut down. So I want to start by sharing a chart here. Just to give you a little bit of this is just kind of interesting before I go into the main thrust of it here. So here's something that's really different about today's market, and this is over the past 5 years. So this isn't just 2020. But one thing that's happening right now is a lot of these big names: Amazon, Apple, Facebook, Google, and Microsoft. Many of the names, which interestingly, with this pandemic, have almost started to become your blue chip sort of consumer staples. Think about Amazon as a tech company. A pandemic hits, and all of a sudden, it actually looks more like a consumer staple. One thing that's happening is that the top 5 companies in the S&P 500 are actually performing way superior, far superior to the remaining 495, both since the pandemic hit. You can see that really steep upturn in that white line there over the past few months. But this isn't new. This is really over the past 5 years. Whereas the rest of the S&P has only returned about 25%, those top 5 names cumulatively have returned over 250%. So just a little bit of perspective for you on what's going on right now in the market. Now, just to get back to some of the disconnect between the market and the economy. Oop, that's a little big. There we go. One thing that's happening right now is the Federal Reserve is pumping a ton of money into the economy in a lot of different ways. And I'm going to try to keep this high level as much as we can, just to keep this understandable. But at the highest level, M2, which is money supply, and this chart that you're seeing here is year over year growth in the money supply, is basically higher than it ever has been. So where we were at the end of 2019 down here and where we are now, Okay, so money supply has grown almost 20% year over year. And as you can see, it has never grown this fast in the history of the record keeping of money supply from the Federal Reserve. Now that is important for a few reasons. The least of which is that obviously with the economy shut down, the money is needed to continue the economic activity. The other piece of what happens there is, there it is. When money supply gets pumped up, what tends to happen is the market does the same thing. So Rick and I kind of referenced this chart probably more than we need to. We tend to always come back to this. But what we're looking at here is, in red, is the Federal Reserve's balance sheet. Okay. The higher that red line, the more money is in the economy. The blue line is the stock market. And what you can see, these shaded gray areas are recessions, is if you look at 2008, what's interesting is you can see when the recession started here and when the recession ended, right? That's the gray shaded box. The Federal Reserve started pushing money into the economy during the recession. They started to create that liquidity to help businesses stay afloat, to help that economic activity continue. And what happened was, if I just kind of draw a line here, as their balance sheet grew, so did the stock market. Right? So that doesn't take a whole heck of a lot of, technical training or financial savvy or economic research to realize that when the Federal Reserve is pumping money into the economy, asset prices or stock prices are inflated. And it's actually, you can see the inverse as well. Once that started to subside, if you remember, we had a pullback happen at the end of 2018, September through Christmas Eve. Rick and I talk a lot about how it was the week of Christmas, and we were doing a lot of trades because the market was down almost 20%. And it's funny because you can see the reason for that downturn right there is the Federal Reserve started backing off on its money creating program. Okay, so there's a pretty good relationship between the two, and this is where the old adage "don't fight the Fed" comes into play, because as long as the Fed is pushing money in, typically the market does go up. Now, the difference, obviously, in this case is we're in a situation where the global economy is shut down, so it wasn't quite the same in 2008 or really any other recession that we can point back to. So this is a little bit different than what we've seen in the past, but by and large, when money's being pumped into the economy, that is a good thing for the stock market, at least as long as the money is being pumped into the economy. I am going to backtrack here for a second. One thing that we see, which is a way different than the last few bear markets, this chart is comparing the last 4 bear markets. So 2020, this year, we did experience a bear market, and I say that in the past tense because technically the bear market only lasted for 22 days. And we are now in a new bull market. but we are looking here at the past 4 bear markets. And one thing that stands out to you about that red line versus the other 3 is A, how steep of a curve that is. And B, if you look at, I'm going to circle this here, that middle, which is day number 0, that middle line, that's the start of the bear market, just how quickly that line rocketed up. And what we're looking at here is a measure of excess liquidity as a percentage. So, you know, this chart really says to me 2 things. In 2008, which you know, most of us regarded as a generational, once in a generation type of recession, it took the Federal Reserve close to 250 days to actually start creating liquidity. Back then, it was called, back in 2008, they were calling it quantitative easing. And if you remember, there was quantitative easing, there was QE2, which was the second phase of it, and you can kind of see those phases where, you know, there's kind of a little bit of a shelf here, and they continued creating liquidity over time. You know, one thing that is majorly different today about today's market is the Federal Reserve stepped in almost immediately. And this was a major point of the letter, was they did so with more liquidity than we've ever seen. And the chairman, Jerome Powell, essentially said, we are prepared to push in unlimited amounts of liquidity, whatever it takes. And that is something that's something that we haven't heard from the Fed before. Typically, they're committing certain dollar amounts. They do it in phases, and the unlimited liquidity, they're calling it QE infinity, is just something we haven't seen before. So, you know, one thing that we talk about is risk in the markets. And I think that this is very telling when you can have an event that shuts down an economy, and you can look at your portfolio and say, oh wow, I'm up a little bit actually on the year. I think that's very telling about risk, and with what the Federal Reserve is doing, how it actually, if this is going to be the new normal, where they're willing to intervene in markets to this level, I think that it says a lot about what we can expect in terms of risk moving forward. And in a sense, it almost makes the markets less risky to be in, because if, you know, we keep getting bailouts, you know, you could have an economy shut down and still be up on the year. You know, and one thing we talk about in the letter is how, if you think about the trade-off between risk and reward, if equities are going to be less risky, it would stand to reason that over long periods of time, that may mean that we can only expect less return. I think that an important point there, though, is it doesn't necessarily address volatility. And I think that that's one thing Rick and I have talked a lot about, is what this means for volatility.
Yeah. So Dan, give a little bit more detail on you know, although it may overall reduce the return long term, but what about the volatility? How does the Fed, or how can that affect client portfolios, and what are we doing about that?
Yeah. So I think that, you know, if we stretch things out over long periods of time, you know, even if it means lower risk equals lower average return, the interesting thing is that as we saw in 2018, when we have these sort of levers being pulled on liquidity, um, in really in a lot of different ways. I mean, there's interest rate shifts. There are federal funds targets that are being changed. There are, the Fed is buying corporate bonds this time around as well. Even corporate bond ETFs, the Fed is buying. Um, so the interesting thing is that while on the whole it may mean less risk overall in the long term, as these levers are pulled, there are going to be periods of likely severe volatility. Like we saw late 2018, where the Fed just kind of started pulling back on some of the excess liquidity. And we got a really quick pullback of about, I can't remember the exact number, it was like 19.5%. We got a really quick pullback over 3 months. When really, we were looking at that and saying, like the economy's doing fine. Why are we getting this pullback? And it was nothing other than, essentially, if you think about modern monetary theory, like the drain was just sort of being pulled out, and it was just sort of, that money was siphoning out some of the bubble, if you will, in asset prices. So I think that what this means is that if we smooth things out over time, we may see a little bit less risk and a little bit less return. But there's going to be periods where we have wild price swings, and really, to your question, Rick, I think what that means for us is we have to really stay on top of those price swings. And when we see big swings up, for example, in the past 4 months when we're up 40+%, we're going to have to be a little more cautious about putting new cash in when the market has just run up by 40% in a short period of time. And vice versa, when the market is down over a short period of time, 30%, we may want to be a little more cautious about taking cash out. So I think it provides some opportunity within the volatility, but understanding that from a planning perspective, the typical philosophy of buy and hold, if an investment may have yielded 5% in the past, maybe it only yields 4.5 or 4%, because if it's going to be less risky, we would only think that it's going to give us less return if there's less risk.
So I got a question up here that just came up as far as portfolios. The question is basically how do you change the portfolios to be more prepared for this in the future? And Dan, I think we did some of this already during the time frame that the market went down. But why don't you go into a little more detail about the how we reallocate, how we prepare portfolios a little bit more in the future?
Yeah, Rick. So I would say there's a couple things. I touched a little bit on cash, but as far as the investments in the portfolio go, there's a few things. One, we always talk about our major objectives. One, it's always targeting risk appropriately based on what the portfolio's risk objective is. But kind of across the spectrum, it's always about looking at protecting downside, capturing upside. And really at the end of the day, our theory is that if you're protecting when markets go down and you're still coming back up with the market, at the end of the day, you're getting a better return for the risk that you're taking. In this environment where we have rapid asset price expansion, especially on the chart that I showed initially on the 5 major companies in the S&P, we basically are looking at focusing on funds and stocks that are dividend payers, that have high free cash flow, and have a high interest coverage. And what that means is that if the economic downturn proves to be a proves to be longer lasting than we either think it would be or would have further effects, even if we do end up kind of getting back to normal. What that would mean is that those companies are going to be able to weather that a little better. And the theory would be is that as long as they can continue paying their dividend, at the very least, you're still collecting the dividend, which is where the free cash flow comes into play and why that's so important. I think by and large, our philosophy remains the same, which is buy and hold. And that's why you don't hear me saying, well, our philosophy is go all to cash or go all in, because that's just not what we do. But the idea would be is that we want the portfolio to be better positioned long term with the uncertainty of what this means for not just the market but the economy, because as I obviously kind of went through with what the Fed's doing, they're kind of playing games a little bit with the market.
So ultimately, our goal is basically to remain, to stay focused on what the Fed is doing, to basically take the risk off the table as this market comes up. Although we don't want to try to time the market, our ultimate goal is to take some risk off the table as the market goes up. And then when the market volatility goes down, or when the market drops down, in the volatile markets, we just kind of watch what the Fed does and just turn some risk back on to be able to enhance the portfolio a little bit more. And that, Dan, you said that free cash flow also creates a sustainability. So if we go into that long, deep economic recession that they're talking about, those free cash flows ultimately create more sustainability in the companies that the managers are managing.
Right. That's correct. That's correct. I gotta maybe Rick, maybe you want to take this one. Let's see another question here. So it says, how does this recent drop compare to 2008?
So ultimately, the 2008 drop, it actually started October 2007 and went through actually March 5th, 2009 before it started going up. It's not that market was caused mainly by a break in the system, and that break in the system was mortgages. So mortgages, they became too risky. The mortgages were flying onto the market so fast that they were putting them together at a level that created a lot of high risk. They had shadow banks that were actually just processing mortgages and pushing them out as fast as they could out to the market, which actually created more of a shell of mortgages where there were empty houses out there. There were people who couldn't afford to buy houses. That also went part and parcel with, I think it was Bill Clinton back then that basically had reduced or pushed banks to reduce their risk. Because everybody had to own a home at that point in time. So they reduced the risk potential for people to be able to buy a home. And that was a break in the system, because that ended up falling apart and caused banks to collapse. It caused banks to, they came in and took over banks like Wachovia. Wachovia was taken over by Wells Fargo. Salomon Brothers disappeared as we know it. So it was a huge break in the system. 2020, not really a break in the system. It was our economy was pretty strong at the time. And with the coronavirus coming in as aggressively as it did, COVID-19, to actually control it and control the risks of the spread, it was a complete shutdown of the economy. Not quite a complete shutdown, but a large shutdown of the economy where large gatherings occurred. Again, I think, Dan, you said that was the fastest downside that we've ever had, and that went from February 2020, mid-February 2020 to March 23rd. We dropped down 35% at that point in time, and by the very next quarter, back to back, we had in history the worst quarter in history And then the very next quarter, we had the best quarter in history.
Right.
So good figure. So it was 18 months, I think, between 2008, and it was pretty much 3 months, 4 months between the downside and the upside of this last down market. Not to say that we're out of this at this point in time, but that's basically the difference between the two. In 2008, there was a substantial break in the system. 2020, there was no break in the system. And I think the reason why the government was able to step in so quickly and the Fed was able to step in so quickly is because the Fed started creating that liquidity. But the government actually knew what was going to happen as they started shutting down the economy. So they moved fairly quickly to create that more liquidity, $1 trillion in the system with the extra $600 on unemployment, because there was about 12 million people that went unemployed pretty quickly, and then the addition to the PPP that went from $350 billion to $659 billion. So that's the big difference between the two. They knew it was coming, or they were able to react very quickly on this because they knew what was going to happen when they did it. But the break in the system, it took a little bit to get that under control.
Right. I think, and how quickly they reacted, just like how quickly the market reacted, was historic. I think we all remember, this is probably a good segue here, but I'm gonna sort of wrap this section up a little bit here on the Fed. We've been talking about the Fed for a while, but I do want to share this just from kind of a personal planning standpoint, but also if we think about more recent memory and kind of, I'd like to give you an idea of really what this means. And this probably just looks like gibberish, but what this is called it's called the Fed dot plot. So the Federal Reserve meets the Federal Open Market Committee, which is the 12 reserve banks. They meet, and you can see there's 12 dots here. So they all vote on what their target is for interest rates. And if anyone has refinanced a mortgage recently, that rates are at historic lows right now. Even more so than we've seen in recent memory. And one thing that's happening, and these are targets, but one thing that's happening is pretty much across the board. You see 2020, 2021, and at this point in time, again, this is forward looking, so take this with a grain of salt. But even 2022, you can see there are only 2 individuals from the Board of Governors on the Federal Open Market Committee. There are only 2 of those individuals who believe that even in 2022, the target rate is going to be above near zero. So this is kind of telling with how long central bankers really think it's going to take to recover. Obviously lower interest rates, the whole idea is to kind of stimulate economic activity. But the interesting thing here is we pretty much have a trifecta. We have low interest rates. We have a ton of money being created by the Fed, just liquidity being pumped in, money supply. And then the last one is stimulus, which we're going to talk about a little bit in a little bit here. But the last one is stimulus. We have trillions of dollars of stimulus going in. So this reaction was not only swift, but it was incredibly large. They're pretty much across the board. They're doing everything they can to keep the economy, keep the markets propped up. What is remaining to be seen is a few things. Number one, I think that it's been kind of eerily absent. We haven't seen inflation, really at all over the past, at least over the past decade, if not longer. The question is, how long can you keep, pumping cash in and keeping rates this low without inflation coming back and without it coming back with a vengeance? So I think that's something to pay attention to. But the other piece, and we're starting to kind of see a little bit of a crack in the facade here. I don't have a chart for this because it's really just sort of a more recent thing. But one thing that happens is, you know, the everybody's pegged to the U.S. dollar. You know, so the U.S. Federal Reserve System is essentially the central bank of the world. And what's happening is, you know, the U.S. central banking system is just pumping money into our economy, into the U.S. economy. And the risk there is it could mean a decline for the dollar. And if central bankers are too haphazard with it, obviously the ultimate thing, which we don't want to have happen, is it could mean, you know, countries let their currencies start to float free. It could threaten the status of the dollar as the global reserve currency. You know, which in turn creates a whole bunch of problems like inflation. It creates problems like you know, interest rate differences between different countries. So that's something that it's, again, a little bit broader impact, something that we don't know, you know, when or if those things would ever come to pass, but definitely probably something that's out there as a concern. You know, if this were to continue on, that you know, could be an issue. So something will be.
And you can tell that by gold. Gold's gone up, and actually gold's hit highest levels since 2009.
Right. Yeah, gold's become the new safe haven asset. It typically is the U.S. dollar and U.S. Treasuries, but interestingly enough, with this recent downturn and the Fed response, a lot of assets are going into gold, which you know, we see it as it's kind of a, you know, investors are looking at it as, I don't know if we have confidence in in the way that this currency is being managed. So definitely something to look out for. So I'm going to, Rick, unless you have anything else you want to cover on that, I think we've talked enough about the Fed. I'm going to move on to our next piece, unless I'll give a second here if anybody wants to put another question in.
What's our in time on this? It's 4:45.
Yeah. So we should probably wrap up in the next 10 to 15 minutes.
All right.
I'm not seeing any questions. So in keeping with the current headlines, we're going to talk a little bit about some of the stimulus packages that have come out, and more specifically what it means for your financial planning. So we're going to look at the and we've done a couple of different pieces on this, but you know, the PPP, the CARES Act, the FFCRA, there's a whole ton of acronyms out there right now with all these different acts and stimulus packages. But I'm gonna let Rick talk a little bit about the PPP program. Rick actually did a Ask the Expert series on this on the PPP as well as forgiveness. So I'm going to let Rick talk a little bit about that.
Okay. So and Dan participated in at that first Ask the Expert series we did on the PPP, and that was before the Flex Act came out. So what we were trying to convey was more of how the forgiveness worked for the PPP, because there was a lot of questions around forgiveness and was I going to be forgiven if I took the loan? Was I going to be forgiven? And since then, they came out with the Flex Act. I think it was in about May 30th, I think, is when they came out with the Flex Act. And what the Flex Act did was we were originally, our maturity of that PPP was 2 years, and that maturity was set to now 5 years. And if you were, in that 5 years, there's a difference between the 2 and that 5 years. The 2 years is if you took the first loan, you get a 2-year maturity date. if you took it in the second phase, you'll get a 5-year maturity date. There still is some things that are up in the air about that. They may push that full 2 years to 5 years, but we're still that's still part of the question. They also extended the time where June 30th was the deadline to be able to utilize that PPP, and then it went to December 31st of 2020 to be able to actually get the PPP and utilize it. So you have to actually utilize it within they extended that period from an 8-week period to 24-week period. So it was from 8 weeks from the time that you received your loan originally, and now it's 24 weeks from the time you first received your loan, or December 31st, whichever's closer. So they've extended that time frame to be able to utilize the loan, and they've also reduced the amount of money that went towards payroll. So originally you had to use 75% of that money towards payroll. Now you only have to use 60% towards payroll. The other percentage can go towards healthcare, can go towards 401k contributions, profit sharing contributions, as you were doing in the past, and additionally to rent. And there's a few other things on that list. So that was the extent of the Flex Act. Dan, I don't know if you have anything additional on that piece.
Yeah, I think, and I don't think you said this, Rick. One of the other changes they made was if you are an employer and you're not able to rehire an employee, you actually can still be exempt and still be forgiven. So really the bottom line is what they're doing is they're trying to make it easier to essentially get forgiveness for these small business loans, which is interesting. I mean, basically that's what they're trying to do, is make this as much of a stimulus package as they possibly can. Obviously we've seen that with the increased unemployment benefits for employees. And this is sort of the same thing for the small business owner, is they're trying to allow this to be forgiven as opposed to be paid back. I think it is interesting, and I've had some questions on this. This actually impacts a lot of employees too. Just because if you're an employee of a small business, and they're defining a small business as any business under 500 employees, and it does impact a lot of employees. In fact, I can show you there are about almost 4.9 million PPP loans out there. So there's 4.9 million businesses who have obtained a PPP loan, and obviously, all of the employees of those 4.9 million businesses are going to be affected by those loans. This chart you're seeing is breaking it down by industry, which I think is a pretty interesting view of this. But obviously, employees are going to be affected by that, because the small business owner has to comply with a lot of those requirements that Rick just laid out in order to qualify for forgiveness. So, I've seen employees who have gone on unemployment, and their unemployment checks are coming in, and it's a lot more than they thought, because there's a stimulus for going on unemployment, and then they're going back to work, and the employer is trying to pay them a certain amount, and the employee's not quite understanding why. So really what it boils down to is they're trying to comply with guidelines to get forgiveness. So I wanted to talk a little bit about
we got a question up here right now that's basically, what does the forgiveness process entail?
Yeah, you take that.
Yeah. See that? So let me grab that real quick, Dan, unless you have something before this.
Go ahead.
So what does the process entail? is, I was just talking to a lender earlier today, and they're looking at three phases to the process. One is a loan application to your lender. And by the way, the uniqueness of this PPP loan too was it was also available to 1099 employees. So 1099 employees typically don't have the benefits and ability to get unemployment when no work is coming in. So the PPP loan was available to them also. So they have to follow the same process of these three phases. So the first phase is really a loan application to your lender. The lender will send you an email basically stating, here's the application, here's how long it's going to take. You have 30 days to respond to that. And then the lender will have 60 days to review the data that you have and make a decision on it and a recommendation to the SBA. The SBA then will have 90 days to be able to review the application. They also have the ability to come back to you requesting more information if necessary. And in addition to that, the first 30 days the SBA has it. If your decision from your lender came back that a partial is going to be forgiven, but not all of it, you have the ability to appeal in that first 30 days back to the SBA, stating that it should be 100% forgiven, and here's why. And then the SBA will accelerate that to and review that in addition to the review and come back within a 90-day period. So ultimately, there'll be more coming out on that in the next couple of weeks. But at this point, that's the process that they're going to go through to be able to get that forgiveness and find out what that forgiveness is going to be.
Okay.
So sorry, I didn't mean to interrupt there.
No, it's good information. Yeah, so I just wanted to pull it a little bit over to the kind of the employee side, or really just at the end of the day, just individuals. I think one of the things that has come out recently, and this is not, I don't think, talked about enough, but it's called the Families First Coronavirus Response Act, FFCRA. It's actually part of the Family Medical Leave Act. And what it does is it kind of expands what employees are eligible for to both get paid leave as a result of COVID, as well as and the important thing is protect your employment. So if you do this under that act, you're able to protect your employment. So I just wanted to roll through a quick scenario here, and I'm happy to share this. If anybody wants me to send this, just shoot me a note after this. But this is a really helpful chart that I've been looking at, and it kind of just gives it a few different scenarios on COVID. One of them that I thought was, it comes up a lot in conversations I have. Schools or daycares are closed or unavailable due to COVID, and you need help because you got kids at home. So actually, under this act, under the Families First Coronavirus Response Act, you are in fact eligible for paid sick leave for that. Specifically due to care, and that's up to 80 hours of paid sick time for full-time employees. So something that you may want to look into if that's an issue. It's not something that you have to take it all at once. You could do one day a week. You can try to figure out how to get your ducks in a row. But there are a lot of scenarios here where if you're dealing with something related to COVID, and it's affecting your ability to work remotely, work from home, whatever. If there's certain scenarios here where you're actually going to be protected and eligible for paid leave in order to deal with those. So I'm happy to send this out if it's something you need to look into. Last thing, just to wrap up on this, we looked at this in our previous quarter's letter, but this provision, this act came out initially with the coronavirus, but the CARES Act. And I really wanted to key in on one particular planning issue that just in case any of you fall into this category, there is a deadline coming up at the end of August. So one thing that the CARES Act does, this document gives us like the top provisions. This was the same act that gave stimulus checks out, but there were a couple other provisions there. One major deadline is IRAs are no longer required to take distributions for 2020. So if you have taken a distribution from a retirement account this year, you can roll that money back in by the end of August in the next 30 days, and you will not have to pay tax on that this year. So I want to make sure everyone's aware of that deadline. If that's something you want to look into, just shoot me a note and we can see if there's opportunity for that. You will still have a 1099, and you will still need to transfer that money back in. What they've done is they've extended the rollover window, so it's kind of just treated like a rollover. But technically, if you are over 72 and you are taking distribution from a retirement account and you have other ways to get your income, you can push that money back and you won't have to pay taxes on that this year. So that's a really timely thing where if you have the ability to do that, we need to do that in the next 30 days. So let's talk about it.
How are the taxes handled? Just touch on that real quick. If you're already taking your distribution and you're going to roll it back over,
Yeah,
you've already taken, you already paid for it. How's that work?
yeah. So the way that it works is you actually are still going to get a 1099. So what happens is it's just like a rollover. You'll get a 1099 that says you took a $50,000 distribution out, and paid $5,000 to your taxes. If we have the ability to push $50,000 back in, what happens is you get a 5498, which is a rollover form, and it's reported as a rollover under the CARES Act. And your net tax is zero, but guess what? You actually already paid 5,000, so you're going to get 5,000 back on your tax return. That's the way that works.
If you're paying estimated tax, you can actually not pay your estimated tax on the last quarter and let that be part of your estimated tax too.
Yep.
Correct?
Yep. So that went very quickly. I could probably keep talking for another hour, but hopefully that was valuable to everyone. Rick, I don't know if you have anything you want to cover, but if anybody has any final questions, just pop them in the chat here, and
or email us. You can email us, Stan at Planning Capital, Rick at Planning Capital.
Yep. So I am not seeing anything. So again, thanks for attending. We are going to send out a survey. Oh, I found another question here. Hold on.
There you go. Does IRA rollback apply to inherited?
Yes, it applies to all IRAs. So we could talk about that. Shoot us a note, and we can address that for you.
So the answer is yes. It applies to all IRAs. I think you can say that.
All IRAs.
Okay.
All IRAs. We are going to send out, I think I said this at the top, but we are going to send out a survey. What we could do better, what you liked, what you want to see more of, and other than that, we'll do this again next quarter. And if we don't talk to you in between, we'll see you then. Thanks for attending.